Today, we're talking about LLCs versus S-Corp and which one is right for you and your business. What's up, guys? Corey Hankerson here from Legacy Tax and Financial Planning, author of End the Tax Nightmare, Insider Secrets to Beat the IRS and Reduce Your Tax Debt. Today, we're talking about LLCs versus S-Corp and which one is right for you and your business. Here at Legacy Tax, a lot of our clients are self-employed professionals. We have doctors, lawyers, dentists, truck drivers, realtors, etc. So today, we're going to focus on their needs and see which type of entity is best for those guys. So in this video, I'm looking at whether the LLC or the S-Corp offers the best benefit to these types of entrepreneurs in terms of taxation and financial planning. I'll do another video later to discuss some of the drawbacks of the LLC versus the S-Corp structure. And in that video, maybe we'll discuss other aspects of those two structures, such as privacy and asset protection. But in this video, I'm just going to focus mostly on taxation and financial planning. Before we get to that, though, what is an LLC and what is a corporation? The LLC is really the new kid on the block. It didn't exist until 1977 when the state of Wyoming enacted special legislation specifically designed to benefit and attract oil companies. Today, all 50 states allow LLCs. The term LLC itself stands for Limited Liability Company, not Limited Liability Corporation. I hate when people say that. And an LLC combines various elements of the corporation with elements of a partnership or sole proprietor in the case of a single member LLC. Limited liability means that its owners, which are called members, are usually not personally responsible for the LLC's debts or liabilities. So if the company were to file bankruptcy, the members don't have to use their personal money to pay for company debts. If the LLC is hit with a lawsuit, the members usually don't risk losing their personal assets to satisfy any type of judgment that would arise from the lawsuit. But what about an S corporation? A corporation is a legal entity that can be created under state law, and it's allowed to do business in its own name, and it must file and pay taxes in its own name. Corporations were invented literally hundreds of years ago to cover risky things like voyages around the world. Before this, if a business failed, the owners would be exposed to unlimited personal liability. With a corporation, the most they could lose was their initial investment. Today, we use corporations for pretty much the same purpose, to protect the owners of the corporation from risking their personal assets for business liabilities. LLCs and corporations have many things in common. They both provide asset protection, they both act as pass-through entities, and both can be managed relatively easily. But there are some significant distinctions when it comes to taxation. Those distinctions have to do with the way that net profit is taxed from the LLC versus the S-Corp.
Net profit is your gross revenue minus expenses. Net profit from an LLC is subject to 15.3% self-employment tax, plus state and federal income tax. A single filer with net profit of $100,000 would pay 24% in federal income taxes, plus approximately 2% state income tax in my home state of Maryland. Now, here in Maryland, we also have local tax to consider, but we're not going to dive into that today. So we're looking at a combined state and federal tax rate of just over 26%. But for purposes of this comparison, we're going to assume a modest 20% tax rounded to the nearest $1,000. In the first example, we have a self-employed IT professional who has structured his business as an LLC. He earned $150,000 in gross revenue and had $100,000 in net income after he deducted his business expenses. From the $100,000 net profit, he's going to pay 15.3% in self-employment taxes, which is $15,300. That's going to leave him with $84,700. From that, he'll pay federal and state income taxes of $17,000. This is going to leave him with an after-tax income of $67,700. That's $32,300 $300 in total taxes with the LLC. That's $2,691 per month just in taxes. To put that in perspective, according to lendingtree.com, the average mortgage payment in the United States is $1,029 a month. Now, according to Credit Karma, the average car payment is $550 a month in 2019. This means that with an LLC, you're paying the IRS almost double what you'd pay for your house and your car combined. Double. In the second example, we'll look at an S-Corp and see how it's taxed as compared to how the LLC was taxed in the previous example. Here, we have a self-employed chiropractor who has structured his business as an S-Corp. He earned gross revenue of $150,000 and has net income of $100,000, just like in our previous example. Just like the LLC, the S-Corp is taxed on net profit, but the S-Corp offers an opportunity to drastically reduce your self-employment tax that is not available with the LLC. You have the option of taking your net profit out of the business in the form of a salary or in the form of a distribution. You do this by making yourself a regular employee of the business. I can hear you all now saying that I'm the owner, I'm not an employee, but you can be both an owner as well as an employee at the same time. And trust me, it'll be worth it. You'll receive the exact same net profit, but you'll pay some of it to yourself as an employee and some of it to yourself as an owner. First, you'll pay yourself a reasonable salary, ideally through a commercial payroll provider like ADP or Paychex. That salary will be subject to the self-employment tax, and your federal and state income taxes should be withheld. Next, you'll pull money out of the business via a distribution. Distributions are essentially a return of capital and not taxed the same way as salaries and wages. Therefore, they're not subject to the self-employment tax. Now, I know that because the salary is subject to the self-employment tax, but the distribution is not subject to the self-employment tax, the temptation is always there to try and call all of your income a distribution and none of it a salary. But the IRS understands this, they know all about that, and they require that your salary must be reasonable, all things considered. Now, how do you determine if your salary is reasonable? Well, the tax code does not explicitly define what is meant by reasonable, but the IRS can use one or more of several tests to determine what is a reasonable salary for your particular business or your industry. They're going to look at your experience, industry norms, the business's profitability, general economic conditions, among other things. Now, some of these are going to apply in your particular situation, and there could be other ones too that I didn't list here. But you really want to take caution here, because a failure to pay yourself a reasonable salary could trigger an audit or lead to serious penalties. I recommend using a tax professional who knows the ins and outs of your industry. So, in our S-Corp example, the business earned $100,000 in net profit. The owner took $50,000 as an employee's salary, for which he received a W-2, and $50,000 as an owner's distribution, for which he received the K-1. The salary, of course, is subject to the self-employment tax, whereas the distribution is not. The net income after state and federal taxes and the self-employment tax is $73,880 versus only $67,700 with the LLC. The increased net income we see with the S-Corp is due to the decreased self-employment tax. Only half of the net profit in the S-Corp is subject to the self-employment tax versus all the net income in the LLC being subject to the self-employment tax. This results in an annual tax savings of $7,650. That's a savings of over $600 per month. Putting it in perspective, earlier we said that the average car payment is $550. This one tax saving strategy is enough to buy a new car and fill up the tank. Your tax savings will vary depending upon your numbers. If you paid yourself less in salary, your savings could be greater. For example, a $25,000 salary instead of a $50,000 salary would literally save you twice as much in self-employment tax. Just remember that the salary you elect to pay yourself has got to be reasonable under the circumstances. The S-Corp strategy is an excellent way to reduce your self-employment taxes, but there are significant drawbacks that you've got to consider. An S-Corp has a much more complicated payroll, bookkeeping, tax filing, and legal compliance situation. A corporation's got to file an 1120 tax return instead of a standard 1040. The 1120 tax prep can easily run $1,000 to $1,500 per year. Add in professional bookkeeping and payroll service, and you'll spend several $100s per month. In addition, you'll need to issue corporate stock, establish a board of directors, and hold corporate meetings and maintain minutes of those meetings. All of these things make for a more complicated corporate structure. Take these requirements into account when deciding whether the S-Corp is right for you. The second drawback has to do with your retirement. The Social Security retirement system provides a minimum or baseline retirement income for many Americans. In fact, for a lot of people, the Social Security benefit is their only income in retirement. Now, there's a lot of misconceptions out there about Social Security failing, going bankrupt, or running out of money. But make no mistake about it, the Social Security benefits you receive in retirement could be worth hundreds of thousands of dollars over the life of your retirement. In order to be eligible for full retirement, you need to accumulate 40 credits. Now, 4 credits are earned for each year of full-time work, where you make at least $1,300. Therefore, it's going to take 10 years of working full-time to earn your 40 credits. Now, the amount of benefit you receive when you retire is based on the amount you earned in salary or wages, depending during your working years. Now, the amount you pay yourself as a distribution does not count toward calculating your benefits. That benefit amount is only based on the money that you earned in salaries or wages. In other words, reducing your self-employment tax by reducing your salary and paying yourself via distribution will reduce your Social Security retirement benefits. The third drawback also has to do with retirement planning. The amount you're allowed to contribute to a qualified retirement plan is tied to your salary. If you're doing a SEP IRA, a solo 401k, a profit sharing plan, etc., your maximum contribution is going to be primarily tied to the salary portion of your net income. So for example, in 2019, the maximum amount that you can contribute to a solo 401k is 25% of your salary, with a limit of $56,000. In our LLC example, the business owner could contribute $25,000 per year into a solo 401k. But the owner in the S-Corp example would have his contribution limited to $12,500. Qualified retirement plans are one of the best tax shelters available to the average American. Using the S-Corp strategy to reduce your self-employment tax will reduce the amount of money you can put into one of these plans, and obviously reduce the amount of money that you have saved up and available to you in retirement. The final drawback has to do with obtaining a mortgage. The amount of home mortgage that you can qualify for is directly tied to your income. Specifically, a mortgage lender will only want you to allocate about 25% of your salary to your mortgage. In other words, if your income is $4,000 per month, a mortgage lender might only want your mortgage payment to be $1,000 a month. This limits the size of mortgage that you can qualify for. And let's not forget that the mortgage interest deduction is still one of the largest tax deductions out there. So reducing your self-employment tax by reducing your salary will also have the effect of reducing the mortgage amount that most lenders will qualify you for. Tax planning using an S-Corp can be a great strategy to reduce self-employment tax, thereby reducing your overall tax liability. But there are some drawbacks. You'll probably have a more complicated tax, payroll, and legal situation. You might reduce your Social Security retirement benefits, and the amount you can contribute to a qualified retirement plan could be reduced. And you might also reduce the amount of mortgage that you qualify for.
Despite the potential drawbacks, I still consider the S-Corp strategy to be a powerful tax-saving technique for the right circumstances, for the right person. It's very possible that the amount that you save on self-employment taxes will completely offset the increased cost of tax filing, the increased cost of accounting, payroll, etc. And maybe you've already accumulated the 40 retirement credits that's needed for Social Security retirement. And when it comes to saving for retirement, maybe qualified plans are not part of your strategy. That's cool. Or maybe your income is high enough that you can still max out your 401k while also reducing your tax burden. Finally, maybe you've already bought your forever home and you don't plan on applying for a mortgage anytime soon. But the best way to find out whether the S-Corp strategy will work for you is to sit down with my team here at Legacy Tax and Financial Planning and allow us to do a complete analysis for you based on your specific circumstances. We'll help you find the sweet spot between the benefits available under an S-Corp and the drawbacks that come along with it. You can schedule an appointment with us by visiting our website at www.legacytfp.com and clicking the green Schedule Now button in the upper right-hand corner of the screen. Or just shoot me an email at chankerson@legacytfp.com. If you like this video and you want to hear more tax and financial planning information, please subscribe to this channel by clicking the red subscribe button below. That way you'll be notified each time we drop a new video. Finally, please like us on Facebook and follow us on Instagram. We're always posting tax tips and financial strategies that'll help keep your business ahead of the game. That's it for this week, guys. Talk to you later. Bye.